Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, October 31st. Happy Halloween, everybody. I hope you guys have a great and safe day and evening. I hope you guys get all the tricks and treats you want. Hey, we do got a lot to go over today, so we're just going to jump right into the economic calendar. And we'll start off with the weekly jobless claims we get every Thursday. So last week was revised 1,000 people higher. So we had 212 initially, and it was revised to 213,000. Uh, Forecast was calling for 215,000, and it came in a little higher to 218,000. So we had a little bit higher, a little bit of uptick in the jobless claims. Again, jobless claims are something we're going to keep our eye on because sometimes we'll get these fluctuations where it might be higher one week and then come back down. Usually, when you see a trend going upwards, it means that we're kind of in that recession. It's kind of a precursor to a recession, probably because that means companies are starting to lay people off and get the bottom lines in order. And so that's something we'll keep our eyes on. Employment cost index. This is Q3. The previous quarter was up 0.6%. Forecasts were calling for 0.7% for Q3, and it came in at 0.7%. Year over year, only went up slightly, like 2.7, 2.8 range there. So still pretty moderate. This can be inflationary news. This used to be Alan Greenspan, our former Fed chief, way back. Used to be one of his favorite gauges for inflation data. Actually, this is this was something that he looked heavily at. Personal income for the month of September. So we had a 0.5% increase in the month of August, and increase of forecast increase of 0.3, and it came in expectation. So people made a little bit more money in terms of personal income for the month of September. On the other hand, we got consumer spending. We had 0.2% increase back in August. Forecast is supposed to be a slight tick higher at 0.3%, and it came in same level at 0.2%. So it went up consumer spending. So people are earning more than what they're spending, which can be a good thing, but of course we need that spending to keep the economy moving along here. Now we get into inflationary data. This is actually the Fed's favorite gauge of inflation, is the personal consumption expenditure, or PCE. Now this is what we call the headline number, the overall. We had 0% back in August. Forecast was calling for a slight uptick to 0.1%, and it came in at 0. So what this did is the year over year dropped from 1.4% down to 1.3%. Now, when you take out the food and energy, we get what they call the core PC, or this is also core inflation that you'll see the media play out, and this is the true number that what the Fed will look at. They look because the food and energy you have are variables you cannot control, and they will look at the core versus the headline number. So increase of 0.1% in August. Another forecast was calling for 0.1% in September, and it came in at 0. So its core dropped to from 1.8% the previous month down to 1.7%. So our year over year is at 1.7%. The Fed's target rate is at 2%. We'll touch on a little comment that the Fed made yesterday in a bit, but the Fed's target rate is 2%. Now we get to Chicago PMI. This is a manufacturing in the Chicago region. Anything below 50 is contraction, and anything above it is expansion. And as you can see here, where manufacturing is contracted quite a bit here, especially in the Chicago region. So the previous month in September was at 47.1, and it dropped further down, contracted even further down to 43.2, which is obviously not very good news. We'd like to see manufacturing make a resurgence, and unfortunately in the Chicago region, they're kind of suffering a bit. So let's jump up ahead here to the headline news. Stocks are down this morning. After the Fed meeting yesterday, they spiked up, hit some new highs, and today, however, they are down. We'll touch on reason being, but let's touch on what was some of the comments of the FOMC, like a review of what their announcement was saying. So basically, they did cut it by 0.25%. This will be a last cut for a while. They'll become more, instead of accommodative, they're going to be more data dependent. So meaning that they won't be raising rates, but if they raising or cutting rates, but they're going to look at the data as it comes in. If it looks like it needs one or the other, they'll be depending on what that comes into. That's what they'll go. So the stock market and the mortgage-backed securities actually both improved yesterday, but also they made a comment that inflation seems to be mute. So it means like it's very tame. It's not under control. So that's what helped bonds rally a bit yesterday too, because they gave a good indication that inflation is now under control. Even though they're cutting rates, inflation's still very tame. So we do got corporate earnings reports. We had a few big ones that came in yesterday. I think Facebook and I think Twitter, some of these other ones, high tech ones came in yesterday, came in a bit. But one of the big things that came in recently that's really affecting the stock market today is there's a comment out of China that uh, basically they are having doubts that a long-term deal uh, will happen with the U.S. They're feeling that a long-term deal may not be in the cards in there, so there's some doubt there being mentioned, and so that stock market is not is kind of getting hit with that, and of course, as we'll see in a bit, that's helping the mortgage-backed securities and bonds as a result of that. So the Dow right now is down over 200 so far this morning. There's also another announcement. They were initially supposed to sign the first phase coming in next month here in Chile, but that got canceled because the riots are going on down there. So President Trump basically said that they are looking for another location. They want to go ahead and continue with the signing, and uh, so they're looking for another place. So a place to be named soon. It will be mentioned. So they were initially looking at November 9th. I'm not sure if that's going to be continued the date, but we'll wait and see what we hear next. But they are working to try to continue those talks and to have, or at least work on the talks, but at least have a date to sign the first phase of the agreement. Let's kind of move along here, see how this is affecting the bond market. The bond market, as you saw, we had a nice rally in the day. We topped the 100-day moving average, got right up to the 25-day moving average, and today we jumped above the 25 and 50-day moving average. We're up even further, so we're up another 23 basis points. So if you look here, we're right about the 101 mark, and now we're up like over 101.50. So we had over half a point in uh, over half a percent in rates, almost maybe even 70. Uh, what is it, about 70, almost 75 basis points. So what that translates to is almost a 3/8 of a percent in the rate. So we're pretty close to about 3/8 in the rate improvement from where we were yesterday, starting the day yesterday. So that's a good sign here, and I think a lot of people will be interested in that. So as you can see, the stochastic, we had a bit of a crossover, and this is taking off, getting us back into neutral territory. Yields are tanking right now, are dropping. It's fighting to stay above the 25-day moving average. It broke below that Fibonacci, and yes, even above that 100-day moving average. So right now, it's trying to stay above the 25. It's hovering right about 1.70 rate level right now. All right. So that's pretty much a wrap. We got improvement in rates, which is a good sign here, and those are looking to refinance or purchase. That's good news for you guys. So if you guys are looking, speaking of such, if you guys are looking to buy or refinance in California, please reach out. I'd love to talk with you guys. I am a loan officer here with Pinnacle Home Loans. We got a lot of variety of loan programs. We can help out with a lot of different scenarios. And again, we're here for you guys. If you want, direct message me or email is the best way to contact me, especially email is the best solution. And again, love to hear from you guys. You guys have a great rest of your day. Thanks so much for watching. We'll catch you guys tomorrow. Bye-bye.